Well, howdy there, folks. Welcome into this four-piece here today. Four videos up here for me to react to. This first one up here, why the S&P 500 is going to be 5,000 in 2024. So looking forward to getting in that one from the BofA Securities head of the U.S. business. Next one up here, Gene Munster. Mr. Gene Munster expect a shift in performance from the Magnificent Seven to mid-sized tech in 2024. I want to hear why he believes there's going to be a rotation there. Then we're getting to this one. Stocks are the way to go for the next decade if you're accumulating. That should be a fun one to listen to. And then the last one up here, this market can get to 48.25 by year end. Folks, we have a month left in the whole year. 48.25 would be massive upside. That would mean we would have a ripper. an absolute ripper rally in the month of December. So I thought that one would be an interesting one. Appreciate y'all joining me as always. Thanks so much for being here, folks. A little outdoor video here today. It's not too bad out here today. So appreciate you guys joining me. Thank you for being subscribed. If you're looking to apply, join my private group, get access to all my courses, 6- and 7-figure Discord chat, all that good stuff. Then check out the pinned comment down there. You can fill out an application. We can see if we can get you in there either this week or next week. Alrighty, let's get into this.
Be a stock picker's paradise with the S&P 500 hitting 5,000 by year end next year, not this year. Joining us right now is Savita Subramanian. She is Bank of America Securities head of U.S. equity and quantitative strategy. And look, there are a lot of people who are now starting to question that, hey, we've run a long way in November. Maybe we're going to see a pullback on some of these things. You think you're pretty convinced that things are going to go up from here?
I mean, not in a straight line. I think there is a high probability of pullbacks next year around various areas of concern. But I do think that we're in a healthier market setup than we've been in a very long time. So I'm actually feeling pretty good about the market. I mean, if you think about it, it's not even what the Fed, we're not bullish because of what we think the Fed is going to do.
In terms of, you don't expect any pullbacks in rates?
We don't necessarily have a view that's predicated on a big drop in rates. It's really more about what the Fed's already done, which is, the Fed has done a lot of the painful work already, and chances are it's close to over. The market has handled it so far. Sure, there are lagged effects of monetary policy, but if you look at consumers and corporates, I think whenever we say, when we look at things like delinquencies and worry about the fact that they're rising, they're actually just coming back to more normal levels from pre-COVID lows. So I think that we're in...
Before she goes further here, she mentioned about pullbacks in 2024. When do I think a pullback could happen in 2024? And the answer to that is I think a pullback could happen in actually the first quarter. I think we could see, some shakiness in some of the big tech stocks, some of the mega caps in the first quarter at some point in time. I don't know if it's going to be like January, February, or March, but I think there's a high probability we'll see some shakiness during the first quarter. And maybe quite a bit of shakiness, to be honest. I think there's a lot of people that are going to be looking to take some profits, especially if we have a ripper rally in December, that'll be an interesting video to get into here. But if we have that ripper rally, I think there's a high probability you'll get some pullbacks in Q1.
Where the U.S. consumer and corporates actually look pretty healthy. Consumer confidence might be a little bit rattled by the fact that rates have moved higher, but the bulk of consumers have been able to withstand this pressure. And where we're seeing the pain is more in millennials, which are the prime spending group. But I think even there, the bull case that I don't think gets a lot of airtime is the fact that baby boomers are right at the cusp of this massive wealth transfer. So if you look at the average age of a baby boomer, it's the average lifespan of a human being. Grim statistic. But what that means is that we are at the beginnings of this sort of wealth transfer from, the wealthier generation that's sitting on $80 trillion worth of assets to the more strapped millennial generation.
Wait, they're all going to die and give their money to the youngsters?
Well, okay. So, one way of saying it is,
spending is about to go crazy because millennials never had any money to begin with. So when they get some money, man, it's gonna be spending like crazy.
I mean, we're at that point where that wealth transfer begins. But then on top of that, I think
avocado toast sales and cold brew sales are going to go through the moon. Holy
the idea
smokes.
that baby boomers are even spending more on services and goods than they used to. So it's not just baby boomers are taking over all the wealth and they're never going to spend again. I think that there are cross currents that are actually pretty bullish for consumption. So in the U.S., I think that U.S. consumers are actually in a pretty good position.
We have never seen the Fed raise rates by 500 basis points and have it not result in some pretty severe dislocations. Why do you think this is different?
Yeah, the baby boomer generation, let's call it reaching retirement age, has been reaching retirement age. That bodes very well for a few specific stocks come to mind that it bodes very well for. And, one group of those stocks is travel, right? Travel. We do know a lot of people when they retire, they love to go traveling, and they travel and they travel and travel until, you get to a state where your body can't do it anymore or something like that, and you're like really elderly. But up until that time, people want to travel and travel and travel, see the world, see different places, go different places, experience different things that they weren't able to do when they were in their working years, right? And so cruise lines benefit huge. So, cruise lines, Carnival Cruise Line, Royal Caribbean, all those guys will benefit huge over this next, I would say, 10 to 20 years. It's not like it's a 1-2 year thing. It's like this is the next 10 to 20 years. They're going to benefit huge. I think a lot of resort companies are going to benefit big over this next 10 to 20 years. And so that's just a little food for thought in regards to that.
So I think this time is different for a number of reasons. One is that we were at almost too accommodative rates at the beginning. We were at 0, and going from 0 to 5 is different from going from 3 to 8. So I think the fact that we were going from super ultra too accommodative to more normal is one facet of this. I think also on top of that, you had consumers and corporates preparing for a rising interest rate environment, and in fact they locked in long-dated fixed-rate debt obligations at very low interest rates, and I think that's serving them well now. I'm not saying it's going to be gravy from here, but I do think that the one kind of positive where we are today versus where we were a couple of years ago is we know how the Fed is going to get off of ground zero in terms of interest rates. We're already past that point. We've seen massive inflation volatility, and inflation volatility, we know inflation isn't going to be 0. It's not going to be 10, but it's going to be somewhere in between that range. And on top of all of this, we also have an environment where U.S. companies have begun that process of moving IP tech, equipment out of China and less friendly regions of the world back to the U.S. So I almost feel like a lot of the work is behind us rather than ahead of us, and now we can kind of get a better grasp on what earnings are going to look like.
We were 4,800 in 2021.
We were.
So your big bull.
That's a good point, right? When you look at it from that angle, it's like, okay, S&P 500, 5,000 at some point in 2024. Well, that's still almost flat versus where we were at in 2021. Right? Because 2021, we were 4,800 plus. So when you look at it from that angle, it's like, dang, that doesn't seem that crazy at all, right? Looking at the S&P 500 today, that's like, wow, that's a pretty big upward move for next year, right?
Case gets us to 5,000 by the end of 2024. So 3 years later, we have a total S&P return of
not that much.
3 or 4%.
Exactly.
Yeah, that's not a very crazy call.
It's not a crazy call.
But it's only 10% next year.
It's 10% returns next year, which is a
couldn't we do 20?
Above average. I mean, I think we could do 20. It depends on the shape of the consumer. It depends on confidence. But I think the idea is we're one of the higher forecasts on Wall Street.
That's a good freaking point. And if you want to be bullish on this market, I think that's a very important thing. I think that's very important, right? Because the bottom line is, even if we go to 5,000 by the end of 2024, that is horrible 3-year performance. I mean, absolute trash. The fact that the S&P 500 only went up a few percent in 3 years is really bad, right? So, yeah, I mean, this is one of those things you hear it and it's like, dang, that's not even that crazy.
Not that aggressive. I think most strategists are quite bearish at this point.
That's a really
conservatively allocated.
Most people have not experienced what you're looking at right there since 1980. It's been almost straight up since 1982, basically. I mean, this has been, what would you call that? A secular trading range? I guess it's really kind of a secular...
it's a big fat trading range. Yeah. But I think, and maybe we stay in it.
So Deutsche Bank's at 5,100, BMO 5,100, RBC 5,000, Bank of America's at 5,000.
It's not over.
Yeah.
Which basically means that Wall Street is really starting to flip over to the bullish side.
It's 10 years, which would be the scarier.
Could be. It could be you have to start with 2.
I don't think it's going to be a trading range for the next 10 years. I'm bullish on equities for the next 10 years.
About $34 trillion in debt.
Okay, that's government debt.
It's possible. I mean, it's possible we could be range bound for a decade. And let me explain exactly how that happens, okay? So let's say next year is good for the market, okay? Let's say 2025 is good for the market. And then let's say the Fed lags really start to catch up with us heavy. End of 2025, 2026. And let's say we actually get the big recession everybody's been calling for the last several years. Doesn't happen next year. It doesn't happen in 25. Let's say it finally happens in 26. Okay. And let's say it's a big one, big nasty one, similar to the great financial crisis, right? So let's say going into that recession, S&P 500's at 5,700. Okay, let's just throw that out there. 5,700, 2026, the big recession happens. Next thing you know, S&P 500, gets nailed. All the stock market indexes go. S&P 500 goes from 5,700 down to 3,000, right? Which would be actually less of a drop than the Great Financial Crisis. Keep in mind, the Great Financial Crisis, peak to trough, was over 50%. So next thing you know, we're at 3,000 in, let's say, 2027. Okay, so now we got to climb back from 3,000. So Fed drops rates to nothing, quantitative easing, all the stuff, right? Economy improves 2028, 2029. Next thing you know is 2030, and the S&P 500 is 5,000. That's how it happens, folks. That's how it happens. That's how you end up having kind of a lost decade, which is what we had actually in 2000 through 2009. We had a lost decade in there, 2010. And it happened because you had that big market crash. So I will not be here to say, it's not going to be a lost decade. There's potential like 2020 through 2030 is a lost decade. You need a big recession in there, though. I mean, a big one. Not like, little baby recession. You need a heavy recession at some point to screw everything up, tank the market, and then you have to work back up coming from that, okay? So anyways, that's how you get there. That's how you get there, right? And it's possible at some point in this decade we have that, right? It could be a year, 2 years, 3 years, 4 years. It could be at some point, right?
Right. And government debt is not anathema for U.S. stocks. Even if we're an emerging economy now and, we're going to be downgraded.
Higher interest rates could be anathema and that's what results from the $34 trillion in debt.
But the higher interest rates, what's interesting is that the higher interest rates are going to hit a lot of pockets of the economy, not necessarily public equities, because public equities have been marked for this environment. What I worry more about is all the stuff sloshing around in private equity, private credit, the shadow lending machine that's been taking place for the last 10, 15 years. But public equity right now is marked to exactly what's happened. And that is a high interest rate environment. We all know what refinancing risks are going to look like. Unless rates double from here.
But I can connect some dots for you between when the government owes that much, they have no money to spend it on anything else that they want to spend it on. And you know what they do? They don't spend less. They try to take more in. So they're going to raise taxes. They're going to raise taxes on corporations. They're going to raise taxes on individuals. None of that is good for stocks.
I don't necessarily see that happening in the near term. I think that one of the ways the government has been able to navigate high deficits is by outgrowing that deficit. And I think that the U.S. economy is actually at a good point at which we could see tremendous surprises in GDP growth going forward. Think about it.
So.
We're at a point where we have had underspend on manufacturing. We have the best technology.
Maybe AI.
AI could be part of this productivity boom. We haven't really seen a productivity boom in a very long time. We've mostly seen earnings from cheap capital globalization. Now we're at a point where we could actually see productivity kick in, efficiency gains.
True, 100%. She's like, you kicking me off the air, man? It's like the Grammys when they start playing the music. Good point, Sarah. Okay, next one up here, Gene Munster. Expect a shift in performance from the Magnificent Seven to mid-size tech. This should be interesting. Okay.
Deepwater Asset Management managing partner. The Nasdaq's up a lot this month. We were just shocked to hear double digits, Gene. So I don't know what that means. Before we talk about the ones you do like, since it's such a popular issue, the Magnificent Seven. Is it too late? Would you buy any of them at this point?
I would, Joe. I think that still you put Google, Meta, Deepwater owns both of those, Apple in that camp. That is a select group, so you don't need to own all of the Magnificent Seven, but I think you should have some exposure. And generally, I think about a tech portfolio as we orient our tech portfolio. we think about a quarter of it is in some of these bigger companies. But there has been a shift and a belief that we have that even though these Magnificent Seven will continue to be steady, continue to be part of most people's and should be part of most people's portfolio, we think performance is going to come from the sub $50 billion market cap companies. These are companies that have been largely forgotten, and I think that we have seen a positive shift in terms of investor and their appetite for this. The Magnificent Seven is up 0.4% over the past week. The NASDAQ up 0.5%. That's rare, just given the weightings to see the mags.
Yeah, I could definitely see that happening. That's what I call rotation, right? And when rotation happens and you think about it from the big dogs to some of these smaller guys, it's not just about going to small cap stocks, the under $5 billion club. It's like Gene Munster's saying here, it's like the under $50 billion club.
And underperform the NASDAQ, albeit fractionally. But more impressive was this sub $50 billion group. And we went back and picked 7 of what were some of the high flyers back in 2021 as kind of a benchmark for what these high growth companies are, these smaller companies. And they're up 3.5% in the past week. And so this is a shift in terms of sentiment. The reason, of course, is that more steady interest rates, just keeping them where they're at, gives investors a little bit of an opportunity to step back and think about owning a broader mix of tech beyond the Mag 7. And so I see this as a real encouraging data point.
There's 2 stocks that come to mind when I think about this rotation of money into the more mid-sized tech. 2 stocks specific. You want to know what those stocks are? Zoom, Palantir. Zoom and Palantir are the first 2 stocks that came to my mind when I thought about mid-sized tech. The under $50 billion club, and money rotating to them. And, Gene Munster even brings up, stocks that were, hot years ago and things like that. Which, by the way, Palantir's been red hot this year. Yeah.
Is that as I checked my feed this morning, you just, we kind of think about what's happening with Cyber Monday. The one piece I would caution related to this, again, I'm very bullish on these smaller ones. But what we saw,
PayPal's almost there. I mean, PayPal's been trading $50-60 billion market cap recently. So, I mean, PayPal's almost in that mid-sized tech area.
Cyber Monday up 8% or 9% year over year. The consumer still is really strong. And so I think that some of these concerns about interest rates and what they're doing is going to linger. But I think on the margin, 2024 is going to be a year where we're going to see a shift in performance from the Mag 7 to some of these smaller, we'll call it smaller, sub $50 billion market cap companies.
So how many of those, there must be a lot of them. How many have you looked at? How many are there? And I don't know how many you're recommending. And the ones you look back, just to test your theory that you look back in 2021, there was no AI back then. Aren't they different? Aren't there some different opportunities now? Aren't there some different names that wouldn't have been as attractive a couple of years ago? So how many are you looking at, and which ones you think we should buy?
Okay, so our short list, we'll call it our watch list, is about 100 different tech companies.
Oh my gosh!
And we own about 20 of those. So just to give you a sense about what the scope is. In terms of those 7, is most of them none of them had an AI bid 2 years ago. And that's what I thought was appropriate, was to, really take those companies that didn't have the AI bid and look at how they've performed more recently. If we would have selected companies that had more of an AI flavor to them, they would have been up more. And then to answer your other questions, what are those companies that we're excited about? They're companies that probably a lot of people haven't heard of. CrowdStrike, for example, is a $50 billion market cap.
They report today, I think.
Cybersecurity company, but that's one that we're optimistic about. One company that, another one a lot of people have heard of, obviously, is Etsy. I think what's going on in retail, that stock has rebounded nicely. It's up about 23% in the past month, but that continues to be an opportunity relative to just still an $8 billion market cap. That can be a much bigger company. And so that's the general lines that we're looking at, is companies that will grow faster for longer is our mandate.
All right, so that's 2. You got the universe.
He wants them all.
And you've got 20 that you own. What else?
He wants more.
Other companies, think about Zillow, for example, and what they're doing in terms of kind of changing how we're doing real estate. Their next version of their app, I think, is going to bring in more metadata. I think they will have an opportunity Palantir is another company that we own that has an AI bid to it. So, they've obviously done a lot. And then we're also investing, when I think about that list too, we do invest in both private and public companies. And so on the private side, there's Redwood Materials. This was founded by J.B. Strobel, one of the founders of Tesla, their battery component manufacturing company. And then Anduril, which does defense.
Palantir's having a good day, by the way. I think Palantir's my best stock today. It's up way more than that now. I'm trying to think, how much is Palantir up now? Let's take a peek here. I think I saw it up 3+% earlier. I'm like, isn't it my best stock today? No, PayPal overtook it. PayPal the best? Let's freaking go, PayPal. That's what I'm talking about, baby. Palantir is now my third best stock. Earlier today, it was my best stock. It was up 3-point-something% earlier today. Look at PayPal. PayPal said, give me that. I want the reward for the top stock here today, man. That's what I'm talking about.
Tech. And so our portfolio is comprised of both public and private. It's a hybrid fund. So those would be 5 companies that we're excited about.
Did you mentioned Tesla, but you didn't mention it when you were talking about the Magnificent Seven. What, do you got like a hold on that?
Yeah, I think Tesla's one that's going to continue to do well. I think what we're going to see with Cybertruck here is it's going to be announced, the handoff event, the delivery events on Thursday afternoon. And I think that's really going to stoke investor optimism around this. So I am optimistic on Tesla. The reason why I don't mention it as one of those 5 is because I don't see it having a 2 or 3x upside opportunity over the next year. And that's the kind of goal that we're shooting for, these companies that have more significant upside. But I just want to quickly focus in on Tesla because I think that this is an important week for the company. Cybertruck, I want to caution, isn't going to have a big impact to numbers over the next few years. It's going to take time for them to ramp up manufacturing. But I think from an expansion to multiple perspective, I think this is going to be an important event. They're now showing the Cybertruck at 15 Tesla retail stores, and people are lining up to see this car.
Oh, yeah.
This is exactly what we saw when they originally were showing off the Model 3. And I think that investors largely did not appreciate this pent-up demand piece are not appreciating this. And so I think that to answer your question specific to Tesla, I think that the stock is going to move higher in the next week as we start to see Cybertrucks in the real world. And investors are reminded that Tesla is doing something, is being more aggressive in terms of how they're pursuing the future relative to other car makers.
You don't think that any of the other Magnificent Seven that you like are going to be 2x or 3x? You're talking about the sub 50 billion or
right.
The 2x and 3x.
We orient our portfolio to be more focused on some of these sub 50
right.
$50 billion.
I meant the law of large numbers. None of the Magnificent Seven are going to be 2x or 3x.
That is correct, but we don't want to be all Mag 7 for our portfolio, and so we just limit the number that we can have.
There's one big tech stock that I think could still do another 2x in the next 12 to 18 months. You know what stock it is? Meta. I'm not banking on this, certainly, but if I was to say one stock to 2x in the next 12 to 18 months, it's Meta. And the reason being is it's so undervalued still. And on top of that, I think they're going to destroy all these analysts' expectations. So it's already very undervalued if you look at it on a valuation basis based upon what analysts have the company earning over this next year. I think they're going to blow those numbers out of the water, quarter after quarter after quarter. So I think analysts are going to have to keep bringing up their numbers. I think they're going to have to keep raising price targets on Meta over this next year. So if you forced me to pick one of the big dogs that has a real chance to 2x in the next year and a half, that's the one I would actually go with. All right, the next one up here. Stocks are the way to go for the next decade if you're accumulating. Let's hear what they have to say.
CNBC contributor Seth. Seth, the stocks you're highlighting today are kind of boring, aren't they? But sometimes boring is good in terms of a diversified approach.
Absolutely, Joe. I mean, if you look at it, and one thing I'm saying is, you can still own the Fabulous Seven, but you have to look at other areas too, especially as we go into year end. Boring is good. Stocks that are out of favor, you've got a couple of things going here. People are selling them for tax loss reasons. They might not come back and buy them. And these are stocks on a valuation basis that we find very attractive. I mean, companies like Freeport, if you look at the supply of copper for the next decade, we just don't have enough production there. And as demand increases for many things, not just EVs, but just globally, I think you want to be in a stock like that.
I don't know anybody talk about Freeport in a minute.
A boring utility like AES that's down double digits for the year with a 4% dividend yield. That's a company that's got earnings growth for the next 3 to 5 years. So when you look out there, and then your parent of CNBC, Comcast. I mean, here's a company that's got steady cash flow, growing dividend, very strong management team. And there are a bunch of catalysts coming in the future. But again, these are stocks that people aren't paying attention to. It's been, hey, let's just look at kind of what's growing. And I think you're going to get some opportunity if you put capital in these areas.
I mean, if you're good at what you do, Sarat, would you ever need to buy a bond 5, 10 years? I mean, do you still do that? Do you still put a percentage in there just as sort of a base? Because it seems like you can find stocks that have not quite the same yield, but almost the same yield, and the dividend will go up over the life of a bond, 5 or 10 years. The dividend goes up over 5 or 10 years. And, if you've got that time, it just seems like such a much better place. You're never going to make more than what you put in. You might make less with a bond if you sell it early, but you're never going to make more.
You're absolutely correct. And I think where the answer to that question comes to the client's objective. So if you've got somebody who's close to retirement or in retirement that is no longer in accumulation stage, but really needs capital preservation, that's where bonds, especially now compared to, and we've had this conversation for the last couple of years, the bonds are 1 or 2%. You were much better off at dividend growth. Today, if you've got clients in that area, and I'm not talking about the younger ones, the older ones, they just don't want the volatility in their portfolio. So if you're getting 5 to 7%, 3 to 5 years for a piece of your portfolio, that is actually pretty good. So you are seeing that come out. But what I also am saying is, like you said, you've got dividend growth stocks that are keeping up with inflation or better than inflation, and you get the capital appreciation too. The other thing that you also get the benefit with stocks, especially in a taxable portfolio, is you get a taxable benefit because bonds, corporate bonds or treasuries are taxed at ordinary income. So in a regular account, you're absolutely correct. But again, I would buy bonds for my clients who need it, who actually want to preserve capital. But if you're young and you're accumulating and you've got a high risk tolerance, stocks are the way to go for the next decade, and we've seen it, for the last 100 years.
I mean, it is possible that you can get the wrong company at the wrong time, and you end up losing 20, 30, 40% of your principal. Nobody needs that. So I understand the rationale for a bond, but if you're any good at what you ought to do, you ought to be able to find something that, right?
And what you do is you create a diversified basket of stocks. Right. So you don't just say, I'm going to have 40% in one sector. Exactly. You're going to, just the stocks we mentioned, it's energy, utilities, media, healthcare. That's where you want, and you do top down, bottoms up. And then if you find the good companies, you get diversified.
Interesting. Okay. Next one up here. The market can go to 48.25 by year end, says Piper Sandler's Craig Johnson.
Major indices on pace to have their best month this year. Something few predicted.
That's like 300 points up. There'd be a 300 plus point move for the S&P 500 in December, which would be absolutely massive.
Stocks were in the midst of an October correction, except if you were watching Last Call. Piper Sandler's Craig Johnson predicted right here last month that stocks would rally.
It's about 14% upside. We're already seeing divergences in terms of interest rates. We're already seeing this market fairly oversold on some overbought, oversold oscillators.
I feel like I reacted to this guy. Wasn't the other lady on? She offered to buy him a beer or something like that.
Breadth of the market has already deteriorated. We've thrown a lot at this market.
Craig was on the money, and since then the S&P 500 has popped 8%. It's now about 1% away from its 2023 high. And you've got more analysts on the street joining the bandwagon now. Deutsche Bank today predicted the S&P could gain more than 11% and hit a record high next year. Look who's here in person, the man, the myth, the legend, Craig Johnson, chief market technician at Piper Sandler, at least for that last call. You see what I did there?
I did. Thank you very much.
So let's talk a little bit about Deutsche Bank's prediction. You didn't tell me what you thought about 2024, but one, is Deutsche Bank on target? Do you think that that's a reasonable expectation for 2024?
We see upside for next year. Now, Contessa, we haven't put out our 2024 outlook yet. That is coming next week. So you'll have to have us back next week for the 2024
call.
That's
not a tease.
And from our perspective, we do see upside, and our bottoms-up models do suggest there's upside. But I don't think it's going to be quite as bullish as what a lot of people are thinking at this point in time. There's upside, but maybe not quite as much.
Okay, what drives the upside then? We've seen so much of this rally based on big tech. Are there other sectors that could...
Yeah, if you're thinking about the indexes, something that could hold back the indexes in 2024 from getting much bigger gains is, let's say we're in a situation where December market rolls, okay, and, it goes upward another 3-5%, whatever, right? Well, so we're stealing some gains from 2024, one. Two, if you have rotation from some of the bigger dogs to some of the smaller dogs, well, the smaller guys don't have much weight on the market. But if the big guys just sell off a few percentage points, it takes the whole S&P 500 down. It takes the whole NASDAQ down, right? So I think that's a little food for thought in regards to, the indexes and if you're bullish or bearish on them for next year.
It's higher.
So if we break apart what we think is going to happen next year, it's really got to come down to two things. Number one, the Fed is probably done next year. Number two, the yield curve probably becomes uninverted or a normal sloping yield curve. Those are two things that we're thinking about for next year. And so from our perspective, this market has to broaden out. What we had talked about last time we were on last call was a broadening out of the market, a big rally off the lows. That is starting to happen. And in fact, last Friday, Contessa, we got buy signals on our intermediate term indicators and also on our new highs, lows indicators just last week. And from our perspective, this suggests to us that the intermediate term trend is still up. There's still more to go. This market can get to 48.25 by year end from our perspective.
What? Wow. Okay, so you think in a month we could get that much higher?
Absolutely. When we go back and we look throughout history, what we found throughout history is there's been 13 periods where we've seen in the last 28 trading days of the year, we've seen these very significant rallies come into play. I can tell you there's going to be a lot of year-end window dressing going on with portfolio managers because they've been on the wrong side of this trade all year.
True. I just wonder how many of them already positioned in November versus, waiting for, December. But damn, man, I'll say if the market goes to 48.25, I'll probably make a couple $100,000 here in December. Like if that happens, and I'm certainly not banking on that, but I'm thinking I'd probably be up minimum $200,000 across my accounts, probably 300 plus if that was to actually play out in December.
And they're going to have to play catch up. And that's what I think is going to have to happen.
What causes you concern at this point? If those are your very bullish predictions over not just next year, and you've got all year to see that come true, but in this last month of trading for 2023, what could stand in the way?
Well, I guess what could stand in the way is more geopolitical conflict. I mean, could certainly be a concern at this point in time.
But so far in this rally, we've seen that largely blown off.
Correct. And all these things that should have been problems are sort of being ignored. The Fed is now looking like they're done.
It's because Wall Street needs this market up into year end.
And everybody had priced in another rate hike, and it doesn't look like that's going to happen. So a lot of these concerns and more of this soft landing scenario, Contessa, seems to be playing.
And that's what I worry, in Q1, I worry about some of this talk coming back into the market and then them shaking it up more. Remember all those things we were talking about back in October? Now let's talk about them again come January, February.
So at this point in time, it's got to be something new geopolitical to unfold. I don't see it happening at this point in time.
And I know that you're really optimistic about small and mid-cap stocks. Why?
Absolutely, because we're starting to see the market broadening out. We're starting to see things beyond the Magnificent Seven starting to begin to participate. And we're starting to see financials participate. And as that happens, those are going to be the biggest drivers for the Russell 2000. Financials, industrials, and we need to see some healthcare pickup. And with the conference we got coming up this week in New York, Contessa, I'm hoping we start to see a pickup in the healthcare stocks.
Craig.
Yeah, and as I stated, I think it was it last night's main channel video? I was talking about either small caps roll in 2024, means they all go up quite considerably, or the market breaks in 2024. There's really only one of two scenarios to play out. And I think there's probably a higher probability small caps do very, very well overall in 2024. Okay. Appreciate everybody joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. New all-time high subscribers in the history of the channel. If you're looking to apply to join my private group, check out the pinned comment down there. You fill out an application. We can see if we can get you in there either this week or next week. You get access to all my courses. You get access to the 6- and 7-figure Discord chat, the moves I'm making out there, my nearly $2 million Fidelity account. So yeah, appreciate y'all. Much love as always, and have a great day.